August. I am Scott Tomlinson, and with me on the call today is Paul Tepsich, Portfolio Manager and the founder of High Rock. Let's just talk a little bit about August, last bit of summer, and as traditionally happens, that tends to bring volatility into financial markets. Global equity markets were down close to 5.5%. Before rebounding at the end of the month, and balanced portfolios were little change. Paul, anything to add on any of these specific financial markets?
Nope, just the obvious. The charts look like a roller coaster, and that's what it was over the course of the month. That's for sure.
Yep. However, it's interesting. Balanced portfolios tended to weather the storm reasonably well. So I think that's something our clients can take to heart. Something that certainly did assist is that the Canadian dollar saw the highest level since 2022 in July, but slipped significantly throughout August. And I think that mitigated a fair bit of client exposure to US dollar assets, US equities and things, which does suggest that there is economic uncertainty coming. And I think we'll turn to talking about inflation in the Bank of Canada just a little bit further in the program. Anything to report, Paul, on the high yield mandate?
Not really. We added one preferred share for those folks just right at the end of the month. One that we don't own in our balance mandates, but it just because it doesn't quite fit, although we'll keep an eye on it. But that was really about the only addition over the course of the month. The high yield market in general has performed quite well, even with the rates backing up over the course of the month. So yeah, nothing really to add there, Scott.
Okay. Again, as a reminder, always we're looking at short-term situations in the market, but we are focused on client goals-based long-term planning. So if you have any specific questions about your portfolio and your asset allocation strategy, your wealth forecast, and your long-term goals, we're always available to have these conversations. I've had a few conversations in the last couple of weeks, all good and interesting. So always happy to continue to have conversations with clients. Please let us know if there's anything you need to discuss. I said we talk about the Bank of Canada. Today they left the rates unchanged. However, there is still concern about underlying inflationary pressures, specifically alluding to the inflation rate as of July, or for July, which jumped about 0.5 percentage point from June. I think that will keep the Bank of Canada vigilant. And as they said in their press release today, they remain resolute in their commitment to restoring price stability for Canadians, which usually means that they're going to continue to slow the economy. And that is something that we have to be watchful for. Interestingly, the mortgage interest cost index posted another record year-over-year gain, which means that certainly households are feeling the pinch. And I'll talk about that and what it might mean for the global equity strategy in just a second. Paul, do you have any comments on inflation, interest rates at this juncture?
Yeah, I mean, I would just add that the bank will, as you said, they'll be consistent in trying to get inflation down to 2%. And one of the ways they're going to do that, I don't think they're going to hike again. I do think, and they said today, they will continue using quantitative tightening. So as bonds roll off, they're not actually reinvesting the proceeds. That will continue to put a tightening mechanism in place. Yeah, that mortgage interest cost is stunning. You just have to think how much the other components of CPI are dropping if that's going up 30% year over year. Yeah, I'm at a loss for that one. I'm not sure what the bank is thinking, but they're their own worst enemy, if you ask me.
Yeah, and again, that's playing into what we're seeing in anecdotally from our clients. As we've seen higher equity prices this year. As we rebalance client portfolios, we take sales to bring them back in line with their asset allocation strategies, and especially for those who need continuous cash flow. But we're also seeing more cash flow needs with higher inflation, higher interest rates taking their toll on household budgets, and I think that's telling to a degree that households are feeling the pinch, and that is again going to be difficult on the consumer side of the equity markets. So people are going to postpone purchases, and I think that's going to be impactful on stock markets as earnings are squeezed. And it's something that we have to keep an eye on. But I've been happy to take sales with higher global equity prices or higher equity prices recently. Paul, do you want to talk about the tactical strategy at all?
Yeah, not much to add. We sold our entire position in Auto Canada. We mentioned this was really not a long-term hold. It was more of a trade, if you will, quote unquote. We were able to take out about, depending on the client and when you bought in, but most of our clients, we were able to take out about a 33% return on that trade. That company does not pay a dividend, so it was just a total return. So we were entirely out of that. We could look at it again, but again, it would be more from a short-term trade as opposed to a long-term core holding. The other thing we did right at the end of the month is we added to a very still small, but a Baytex 2030 bond, 8.5% coupon, and that had about a cash yield of 8 3/8 when we bought it. Just adding to some energy exposure. And then shortly after that, I guess yesterday or the day before, this was yesterday, OPEC plus Saudi Arabia and Russia announced further, not further cuts, but further term limit on their cuts that were pre-announced. So oil has popped up and we're at the highs of 2023. And I still have a very positive view on fossil fuel energy risk going forward. So that was the only real addition there.
Well, that's been a pretty good call of yours since way back in 2020, I guess, right? So, and then that's something that's been a lot different, I would say, about what High Rock has been doing for our clients and their portfolios with exposure to fossil fuel energy. So well done on that, Paul.
Thanks.
Fixed income strategy.
Nothing to add here. I mean, obviously rates had a tough go, moving higher, which bond prices moved down, both in government bonds, investment grade were down a little bit. High yield actually helped and performed pretty well. Preferred shares had another rough go. Some of those are getting extremely cheap in our model, getting out towards 9%, 9-10%, and even higher, including one that we bought for the high yield mandate, up or just north of 11% implied internal rate of return on the model. So that's extremely generous, if you ask me, and cheap. So yeah, there's something to keep an eye on for sure. I think they're just being spit out, and people don't really understand how they get valued. But really no additions in there.
Yeah, and the great thing about preferred shares is they pay income in dividends, and dividends are very tax efficient.
Yeah, very true.
All right. Well, thank you all for taking the time to be with us. On behalf of Paul and myself, have a great September. Summer coming to a conclusion. Kids are back in school. So we'll be back with another version at the beginning of October. September can be volatile, so can October. So stay tuned, and we'll keep you up to date on what we're seeing happening and what's going on in the in financial markets and the economy. But until then, enjoy.